Hey guys, we are live with the macro market report. I've changed the name 50 times. Market report, macro report. We'll just put them both together and just call it a day. All right. Sorry guys, this isn't my main thing. I'm not a marketer. I'm just a trader. But I just kind of want to go over a couple things to start the day. So if I go on and check out the industry groups, which is always an interesting one. There's a bunch of different websites you can go on for this. FinViz to me is probably one of the easiest ones. Koifin's probably my favorite, but FinViz is just super easy to go to day after day, see what the performance is for each sector. So if we look at the sectors right now and we go, okay, a one-day performance scale just today, real estate is up the most, almost 1%. Healthcare rate behind that, energy rate behind that, and in last place is technology, down 1.5%. On a 1 week relative time frame, energy is in first place. Technology is at the end of the pack, down over 2%. On a 1 month time frame, technology is still leading the way, up 8%, and near the bottom is energy at the moment. And then on a 3 month time performance, we have utilities leading the way and consumer cyclicals in last. Half year performance, communication services, technology, both basically just technology. And then last place, real estate. And on a 1 year or just year to date basis, we'll look at communication services, technology, utilities, then financials, then energy. So it's kind of interesting. The one for the last week was the second one. What was the second thing you mentioned other than FinViz? Koifin, Koyfin. So that question was here. So if you guys didn't hear me, there's a great website. I don't know if it's free anymore. It used to be completely free for years. But I think there's still a free part of that service, which is you can basically just get a lot of their data, a lot of their charting software, and I think you can just get that for free still. If not, if it's paid, it's honestly one of my favorites to use. I'm not paid for them. They do not give me free research. I'm just saying it's a great thing to use. But Kashop and I have been talking for a while, and we've been saying a very similar thing, which is I don't know how many legs this technology run has on it anymore at this point. And I've been very honest about, we still have our long signals, however, and we're still long it at the moment right now. A move down of this magnitude isn't going to shake out all of my positions. But once again, something we've been talking about and something to keep in mind is that there is a rotation happening. And even looking at energy, we're looking at that sector start to pick up steam, even in the face of oil isn't really doing too well. Neither is gasoline nor heating oil. None of these are doing very well. And the energy sector is starting to pick up. That is one of the most, and I know people don't really talk about this much, but that is one of the most risk-on signals that I ever see. And why I say that's one of the most risk-on signals is when you're seeing the commodity itself struggle a bit, and then the sector is actually able to turn up in a week. That's a really big signal. That's trying to say something about this market. It's trying to say there is interest in that sector, and most likely the oil will catch up to it. Sometimes there's alpha in the actual commodities, meaning the outperformance. You can buy the oil, and when you buy oil, you'll get that outperformance that you're looking for. And other times, there's that alpha in the actual sector, in the actual stocks themselves. I'm seeing right now that it's kind of saying that there might be alpha in the stocks themselves, and you want to buy that sector or individual stocks inside of that sector. But at the same time, it's only a 1 week time frame at the moment. It is a holiday week. So we have to kind of temper our expectations and just kind of continue to watch and see what we see going forward. And then kind of going through just some of the commodities. If we look at commodities performance, once again, FinViz, very easy to use for this if you guys use it. On a 1 week performance, well, actually, let's go month to date. Let's look at month to date because that's always a good place to start, especially as we are at the end of this month. Orange juice up top, 20%. I know everybody trades orange juice. Everybody's probably waiting for me to talk about orange juice this morning. Orange juice is up 20%. It's everybody's favorite trading product. I think it's more popular than NVIDIA, right? No, I'm just kidding. Nobody cares about orange juice, but I'm telling you, like, there's lots of commodities out there and small contracts that everybody can trade, and that is one of them. So take a look at it. Silver, the next one up here. So silver up 16% in a month-to-date performance. That's really big, 16.5% actually. Natural gas up 13%. It's given some back lately, but it's still had a very large move. Wheat right behind that, 12.5%. It's down a little bit today, and it was down over 1% yesterday. But still, that's a great move in a month. That's the reason why we don't trade in such a short time frame where it's like, oh my gosh, it's down 1%. I have to get out of everything. It's like that's a normal pullback inside of a bull run. Platinum right behind that, canola right behind that, soybean oil right behind that, and in last place is the VIX. So once again, we're seeing this market. Let's see. I get distracted. Sorry, I have problems here with watching too many things. I should probably take off some of these because I'll probably continue to go through these as I go. I'm glad everybody's talking though. It makes me excited to have conversations with people on Twitter, YouTube, wherever. Oil has many effects on the economy, but today it has to be seen as inflationary. For sure. And in general, it should always be seen as inflationary. It is the biggest input for inflation, whether you're looking at the indexes or whether you're looking at the actual inflation reports. Like oil is the biggest part of the economy. I think oil, to me, if I had just a couple indicators to look at the market, I could look at oil and bonds and probably tell you what stocks, what commodities, what gold looks like even, and what currencies look like just through those few little things right there. I could even tell you what crypto possibly looks like through that indicator. So oil is always one of the most important pieces. So Kashop, what are you seeing lately? What is your big top-down view this week?
Not anything particular to this week, but I've been this entire month I've been very concerned with the moves in the Japanese yen and the bond market. And the main reason I'm concerned with those two is because almost no one seems to be aware of what's happening. And the thing about events like this, which don't get talked about, which don't get attention, is that their impacts can be long lasting. So go back to when everyone was talking about, say, Bitcoin or crypto in Feb and March. And that pretty much turned out to be the peak for a while, and all we had was a correction. And with bonds or with yen, what we are seeing is these very wild, erratic moves, and no one seems to care. No one seems to be even aware of what's happening. Like, if you go to Yahoo Finance or any website, the news is all about AI, Apple, China, this, sanctions that, or Trump, or every other thing. And no one's paying attention to the Japanese yen. No one's paying attention to the bond market. And we are clearly seeing things breaking in this market. And made a thread about this, why I think the Japanese yen is the most important macro indicator to look at. So normally I would agree with you where you look at oil, you look at bonds, and that pretty much tells you everything that's going on. But right now, oil is kind of stuck in this range where you have all these bullish catalysts and the price doesn't move either up or down. Kind of seems to be is just telling me that we are in between environments. So the way bonds are moving, you could either have a huge sudden deflationary shock because you have a correction in tech, which is the market, at the same time that yields soar, and that's it. That breaks the market, that breaks everything, since commodities lower the whole hog, especially if the prevailing narrative becomes no more rate cuts or no hope of rate cuts or something of that sort, or the Fed just does something stupid because they don't want to be seen as political and giving in to what Congress wants, what both sides of uh, both the two parties want, so which is rate cuts. So you could see credit card delinquencies going up, which is already happening. You could see the regional banks suffering even more, and you could have a massive sell-off based on that, which is possible, which is one scenario. The other thing oil is saying is it is just had a good run. It is consolidating, and most likely we are going to see lower bond yields, which is bonds picking up, and we are going to see oil and commodities start rising again, which is your stagflation scenario, which is you don't have growth, so bond yields go down, and you have inflation, so commodities go up. And this can all start happening really quickly. And I don't know which way it's going to play out because right now things look very uncertain. So let's talk about the Nasdaq. So if you look at a chart of the Nasdaq, so I like to use Bollinger Bands. So they are kind of my favorite measure of volatility. And what I see is when I look at the bandwidth, we saw this period from around Feb to around April where the Nasdaq was kind of topping out. There was like almost no little volatility, and things seemed fine. And then somewhere in April, you had this huge move in the Nasdaq, which coincided with the increase in the bandwidth. And the Nasdaq just shrugged off that correction and went and made a new high, which is very, very unusual, but it happened. So right now we are again seeing a correction in the Nasdaq, and it's just not clear if it will stick to this trend of you have these carry news, you have it making technical breakdowns, and it all turns out to be a false breakdown and it just keeps blasting higher. But I think probably right now we are at the end of it because we had the Mag 7, then we had the Mag 4, and now we have the Mag 1, and it's just impossible for that kind of run to continue. You cannot have one stock pulling an entire market higher. So we saw Supermicro Computer hit an RSI of 100 sometime around March, which I think has never happened in the history of that indicator. So extreme bullish sentiment like this, extreme price action like this, it has to resolve. Now the thing is, I'm not sure how it's going to resolve. Are we really going to get a deflationary crash, which has been a long time coming, or are we just going to go straight to stagflation? Because the Fed seems reluctant to act when everyone wants them to act a certain way. And it looks like they are deliberately ignoring the jobs data, the credit card delinquencies data, and we have so many people calling for rate cuts now because they're talking about how high rates are hurting the middle and lower class Americans, lower income groups. But the Fed doesn't want to budge because it will be seen as political if they cut rates before an election. So we may actually end up in a scenario where this massive tightening cycle ends up causing the deflationary crash that it was supposed to. Or everyone might just realize that the Fed is anyway going to have to cut to finance the massive deficits and we go straight to stagflation. So I think we are on the cusp of either of these two moves now. So I would be mentally prepared to accept either outcome. And I think as a trader, that's really where you need to be. You cannot stubbornly be in the deflation camp and ignore what's happening in the bond market or the currency market. You cannot stubbornly be in the you cannot be in the inflation camp and ignore that. And you can't be in the deflation camp and ignore the run in copper or the moves that we are seeing in gold. So just have to be flexible right now. And so I see a question: what's the best resource for understanding the Japanese yen's impact on micro and macro? I don't think there is any best resource for that. I wrote a thread on it explaining all the causal factors involved. So if you go to my Twitter, it's the pinned tweet. So I mean, it's a macro story. It's an evolving story. So the way it moves is the way it moves. So if the Bank of Japan does things a certain way and the market reacts a certain way, we'll have one set of outcomes. If the Bank of Japan does something and the market reacts the other way, like the famous Soros breaking the Bank of England, then we'll have a different outcome. So this is a situation that just has to be traded as and when it unfolds. It's not something that can be predicted. So if you go back to the reason the Japanese government bond market is called the widowmaker along with natural gas is because everyone has tried shorting that market for the last 30 odd years and they've gotten nowhere. And then all of a sudden that trade starts working. So you have this long period where people tried the trade, gave up in disgust, and then all of a sudden it moves. So now how it's going to move is something that we don't have a historical precedent to say how this move will happen. We just never know. If you have seen that this market has moved a certain way for 30 years and it's now broken that, is it going to mean revert or is it a start of a trend? The answer to that will only be known a year or two from now. It's not something that you can use right now for trading.
No, that's a good point. And when I think it's always the most important thing, and I always bring this up all the time, and people I think people think I'm trying to um, tell them something that isn't true, which is the most important thing that I can do for traders following me is tell them what environment we're in, or if we're between environments. And even though that sounds like, oh, well, we're between environments, who cares? Like, no, that's the most important thing that we are doing here is we're between environments. This means that it could kind of go two different ways. Stagflate and also it gives you things to look out for. If you're looking at oil, you're looking at bonds, you're looking at the yen, you're looking at the whole macro landscape, and you're going, okay, well, this is what's kind of happening here. If oil breaks out to the upside and starts ripping, that's going to say that copper is right. And what gold was telling us all along is also right. And then we also have to be ready for this stagflationary scenario. And if oil starts to break down, let's say it goes the other way, oil starts to break down, and then copper, let's say it gives a false breakout signal here and starts moving back down the other side after making a new high, then you'd have to go, okay, well, this scenario of deflation is possible. That's more important than just me saying, hey, we're in stagflation. Like if I just say that, that's not exactly the right. It's not exactly the environment. Technically, right now, we're still between a reflationary environment and a stagflationary environment. So we're not even to that deflationary environment yet. But it would be easy to move that direction. And this is where the Fed would start cutting rates. This is where a lot of things would start to come into play that would actually fuel that stagflationary environment. This is why we're almost always very close to between two regimes. Last year, we were extremely into that Goldilocks regime, to that point where technology is taking off. It's very easy to kind of sit into those trades because we're very we're all our dot plots way into Goldilocks. And then as this year kind of came into play, we got very into the reflationary trade, meaning even technology kept going up, but the things that were outperforming were technology, commodity producing countries, commodities started to go crazy. So that's the reflationary environment. And then now the possibility of a stagflationary environment, we're seeing the technology starting to slow down finally. We're even seeing a relative outperformance in small caps technology. We haven't seen that in a long time at all. Now, this is only for this week and going on 2 weeks at most. So it's not something to say, okay, the trend has changed, everything's different now. It's because we've put this on our radar already. Now we're able to watch for this. And I also had something to also show. So that's the US dollar to the yen on the bottom. Or sorry, in green, not on the bottom. In green is US dollar to the yen, and that's the commodities bonds ratio. And what I meant about the commodities bonds ratio is you can really figure out where most things are headed using that ratio. It doesn't mean it's the only thing I would look at. Once again, there's no such thing as a perfect correlation. Every low is not synced up with every high. You're never going to see that. However, the general trends, and one generally leads another one. The commodities bonds ratio usually leads the yen by a little bit. and all the time, every single time. So once again, we have to look at all of these things, but I really do think that if I had to, gun to my head, look at one thing, I could do it. Do I ever want to do that? Do I even suggest doing that? No, it'd be stupid. There's a whole macro landscape out there, but I think it's pretty cool that you can kind of come up with a couple ideas, a couple different scenarios, and a couple different intermarket analysis models, and kind of make those your go-to. And for me, it's my go-to. It doesn't mean it has to be yours. Lots of people have different ones, but I really enjoy this one because it kind of tells me whether we're in an inflationary, deflationary, I can kind of see what's going on with Japan or even China sometimes, like, and it doesn't mean it's perfect. I wouldn't just look at this and trade with it because we don't have to do that. But it's cool to kind of see a chart, and you can kind of put other things on this chart and do it. I suggest other people just take this chart. I hate when people act like they've copyrighted certain things in trading. When they're like, "Oh yeah, you take this chart from me. That's my chart." It's like, dude, I stole this idea from somebody. I can't remember at the time, but I'm sure I learned intermarket analysis from somebody. Even books, that I've read. So everything's learned from somebody else. So please take that, run with it, do something with it, and hopefully trading keeps progressing over it. But I really do like this idea that you're talking about, which is being between two regimes and two environments. I think that's the biggest idea that we're going to have today to tell people is that we're in between two environments. And technology could really tell us a lot here. If technology comes back here, and let's say if we look at it completely technically, and we go out far on the scale, and we go, okay, well, where is support? And we go, okay, well, we technically say we're at support right now, first bit of support. And then really, if we started to break some major levels, meaning if we broke that last major low, 17,250, if we closed under that level in the NASDAQ 100 futures, I would say, okay, well, that's possibly the end of that trend. Maybe that's the end of technology being the outperformer. At the time, NASDAQ technology is such a large weight in stocks that I wouldn't think that stocks could even move back to the upside if technology started to break down. I would be surprised. Kashab and I have talked about that a bunch of times. When COVID happened, if I remember right, energy was like 2% of the S&P 500. Now it's like 3%. Like, it's still a very small part of the S&P 500. So now if we just look at that and go, okay, so because people thought in 2022, well, energy might take over, and it's like, it's not big enough. It doesn't even matter. It's a nice thing for people like me who trade the sector futures, because I get the diversification and I can trade something different that isn't very correlated to the S&P 500, but it's not going to hold up the S&P 500. And so technology really has to continue up for the S&P 500 to stay up. But some things to look at here that are interesting too is the DAX. Germany has continued to hold up pretty well in this environment. The Euro Stoxx 50. I can't tell you the last time I saw a signal the other day. It was like Euro Stoxx 50, 52-week high, and then it was like Euro Stoxx 50. I have like a 10-year high signal. It was like a 10-year high, and I was like, Euro stock. What? I've never even I've never traded it before, because it's just, one, if I'm trading Europe, I'm trading the DAX usually. Two, I never see it. It's never on my radar. There's never any outperformance. There's never any reason to really buy it. So seeing that was quite interesting. Japan, if you look at it, a very long-term time frame, the trend is still up. However, it's starting to top out, and the last high, so the NASDAQ made a higher high, and then the Nikkei made a lower high. So when that usually happens, and I always talk about the Nikkei being a great gauge of what's going to happen in the S&P 500, I think that's also a bad sign for the market. So there's a lot of things that kind of have to clear up here to say, okay, the stock market has more upside. One is Japan. The Nikkei absolutely has to break and make a new high, and that has to be soon. At least we need a close over that big level at 40,000. If we don't see a close over that major level, this market's probably in trouble in the United States and globally. And looking at small caps too, small caps actually is the outperformer today, which is quite interesting to see small caps starting to finally catch up after all this time. I know so many people have been like, oh, well, small caps are this and small caps are that, and the index sucks. I know the index sucks. Yes, it's a terrible index. I get that, but I'm saying as a whole, using that index as a trading tool or a trading vehicle is actually really important. Understanding where you're at in comparison to things like the NDX compared to things like the Russell or even Japan, like understanding those things is really how you understand the macro environment. And speaking of the macro environment, let's bring up Steve out of the money Straza.
I thought that would be funny because the market's been selling these last 2 days, so I'm a lot less in the money than I was last Friday.
I like it. I like it.
Good afternoon, gentlemen.
So Steve and I, he's Steve. I always call him Steven. Everybody's like, oh, he's Steve. Everybody's like mad at me about it. They're like, he's Steve.
Oh, I told you the answer about that. At home, I'm Steven.
Yeah, I know. At home, you're Steven. Yeah.
So Steven, I get Straza a lot. They all work.
It all works. So we have a good one. So to teach you guys about risk management.
Oh boy,
Steven, and I was trying to take my rental car back. And at this time, my fiance has fallen asleep in the back seat, which she's kind of the one to have a brain when I don't, which is 90% of the time.
Fell asleep is a nice way to say it. She had her headphones in and wanted nothing to do with what was going on in the front seat.
Yeah, that's more the truth. So we're trying to. So basically, we're leaving the event, and I'm like, oh, I think Straza needed a ride to the airport. So I'm like, all right, I'll take him, and we're going. But we were pretty early. We had time. So we're in San Francisco. I completely forget that even though I picked up the car 3 days before that, I forget that the rental car place is not at the airport. No. So I'm driving around the airport over and over again in San Francisco traffic. We circled it like 4 times, maybe
more than 3 times.
Yeah, maybe 4 times.
We tried to follow signs to the rental car place every time, but like we were telling stories and we were talking. We just going in circles, round and round and round.
And every time we got near the rental car signs, Steven would say, "Nailed it." Because I thought we were almost there. We got it. And I was like, oh, we did it good. And then we'd lose it all over again. Finally, my fiance wakes up and just hands me the GPS. And she says, I was kind of having fun watching you guys, but we kind of got to get there now.
She was laughing at us in the back seat until it got time to actually get to the airport.
Yeah, so she was just watching us act like idiots for a little bit. So that was good. Good opportunity to talk about risk management. Very important. Have someone in the back seat throw a GPS at your head. Risk management is important, guys. Remember that.
We gave ourselves a nice cushion, right? So we were able to mess up a couple times.
Yes, exactly. So we did good. I thought we did great.
You have fun with Sonoma?
Yeah, man, it was great. It was a good trip. That was a really fun event. As a person who doesn't drink, going to Sonoma almost seems like not a fun event.
Yeah.
But man, that was a lot of fun. I had a lot of fun being there. It was a lot of fun meeting all you guys. Like, you guys were great. You guys had a bunch of really cool people there, people that weren't involved with All Star. People like that one. I don't know if I should name names, but we had the big hedge fund manager, bunch of managers actually, a bunch of really good people, futures traders, just random people were there. It was really cool.
We have such like a nice network, and it's also kind of like the technician community is a tight-knit group. So when we get together like that, for me, it felt like a family reunion.
Yeah,
they're all hugging and shit. That's why everybody has COVID now. But But like it's just like a big family reunion. I think there's like 40 of us with the
Yeah.
wives and girlfriends. So yeah, that was fun. It was fun.
Yeah. Shout out to Ian.
Yeah.
But man, it was really cool. It was a lot of fun. That was one of the best events I've been to. I was telling you, I was like, that was one of the best events I've been to in finance. I've been to a lot of very stuffy hotels and very boring. That was a lot of fun. Food was great. Good people.
We always
Can't
have
beat
fun.
it.
We're good
Yeah.
at having fun.
Yeah, it was good. It was a lot of fun.
Should we talk about markets?
No. Let's keep talking about you guys probably don't want us to talk about markets. You want us to probably keep talking about the airport.
All right. I got one. Mavericks, Celtics.
Oh,
Who wins and then how many?
I don't know. So, okay. If I really had to put everything on it, I would say if Porzingis is healthy, the
4
Celtics
games.
are probably okay. I don't know if it's 4 games. If Porzingis is healthy, it'd be tough. So once again, if you think about, so it's just like trading. Think about the defense. Think about, you have the risk management there, which is okay. Celtics pretty damn good defensively. Mavericks have the best players though. The 2 best players I would say are Kyrie and Luka. So there we go. Won't go on too much further. I know everybody's probably really excited to talk about everything but trading here, but I could talk about that forever. I'm going to shut myself down because I'm really excited about it.
Celtics are good, man.
Yeah, but so is the Mavericks.
Well, Kyrie Irving. I mean, Irving. If he's there, if he's scoring, that's gonna be tough.
It's a problem. So, what are you looking at in the markets? Out of the money.
This AI trade is really coming undone here in the last 2 days. Things are fine. There's not much in terms of structural damage, but there is tactical damage. We had some big red sticks yesterday, and this is what happens, right? This was Salesforce's report. They were down like 30%. It was really like the worst day in the history of that stock, but it was the sympathy selling that really stood out. It's one thing if a big mega cap comes up, misses badly, their stock gets hit and the rest of the market's unaffected. Yesterday, they were just selling software, cyber, all this stuff just across the board. A lot of the AI trades were getting sold. You see Dell down like 20% here today, right? So that's coming undone a little bit as well. But when you zoom out, even on something like Dell, it's down 20% today, still in a parabolic uptrend. So I think it's worth monitoring. You don't sell everything and go hide, and it's not like bull market over type of situation. But imagine a scenario where that bad report from Salesforce was NVIDIA. That'll eventually be the case where NVIDIA is going to get sold hard 20, 30%. And I would imagine when that happens, the sympathy selling is going to be a hell of a lot worse than what we saw yesterday and even some follow through on it today. So.
No, I mean, I just looking at the market, I mean, everybody gets too excited into one area all the time, and that's what makes a market, right? It's not that that's a bad thing or a good thing. I'm not saying that, but as a trader, you have to understand that that's going to happen. And as everybody gets too psyched on one part of the market, they put all of their money and everything into NVIDIA and I've never seen a situation where everybody's watching one report. Like everybody's watching NVIDIA. There's people who don't even look at earnings reports, looking at the NVIDIA reports, like it doesn't even make sense. And everybody's stuck on it. That's a problem. That tells me the sector is in a major problem at the moment. So that's just my thoughts on it.
So people are going to come out and say, oh, well, it's a crowded trade. It's been a crowded trade for 12 months. Right? That doesn't make it a bad trade. You do want to be aware of it because when that sentiment turns, it's going to be a lot of people hitting the exits at the same time, right? I don't think you have that dynamic right now in something like oil and gas or some of these materials groups that are working, right? Those are not crowded trades. That would be the opposite. When you start hitting the doors, you get these big red sticks like yesterday, and that's just a risk if you own these names. I'm not saying that's a reason to not own these names. Just be aware of that dynamic when the party ends. So I don't think we're there yet. I think this report did spook the market, and I think mega cap tech needs to find its footing here on a short-term basis. When I look around, whether it's financials or industrials, other stuff continues to work. So I would just say look to those groups for right now for tactical opportunities.
So
No, I
my
completely
best trades of this year, it's not copper, it's not gold, it's something that's not even getting talked about, and it's shipping.
agree.
Yeah.
Shipping stocks are up 30 to 60%. Like they have been on a tear ever since that Red Sea news started. And it's funny, like you got a couple of headlines, and then all of a sudden it's like no one cares. And these stocks are just going vertical. Like every day, I'm like, this is going parabolic. This moves like crypto. This moves like Nvidia, and I don't know what to do, but just ride it. Like Jason has this quote where he says, "Ride the trend to the end until it bends," and that's kind of where I am with the shipping trade right now.
Do you like
And
this,
it's funny,
Kashap?
yeah,
I'm in the Zim. You like the Zim?
yeah. So I had a bad experience with Zim earlier, so I
Not Zim,
avoided the stock.
not Zim. Zim.
Zim, yeah, Zim integrated shipping. So I had a big trade on the stock back in 2021, 2022, and ended up giving back almost all my gains. It was a huge gain, which I ended up giving back. And ever since then, I have not touched the stock. It's just psychologically, it's very hard for me to be in the stock. So I'm into the other shipping names. So Dynamo, Scott, Global Shipley, like all the other container ship stocks that are moving in sync with Zim. I had the dry bulk trades, which is Golden Ocean, Eagle Bulk, which just got acquired. So I had all the other names, but I was just like, I'm so psychologically scarred by this one stock, I'm just going to avoid it.
So,
And I think that's just something that happens.
so I have a question about like this whole group. Something I've never understood. What are they moving? Are all of these just like oil and gas tankers, or are some of them actually just like moving goods?
No, so some of them, Zim moves containers, the
Containers. Yeah.
big 40-foot containers. And the dry bulk stocks, they move coal, grains, all the dry commodities, which is why they're called dry bulk. And then you have the wet bulk, which is the tankers, which move oil, the oil distillates. They move chemicals, stuff
Got it.
like palm oil, naphtha, all the other stuff.
And what do you
And then
call
you have
that?
the LNG.
What do you call that?
We
That's
call them tankers.
so,
That's tankers, oil tankers and product tankers.
okay. So if somebody says
Yeah.
tankers, I should think energy.
Yeah.
So I get to look smart here because I'm friends with Kashap and I get to say certain things. But also the honestly, Kashap's the reason why I know anything I know about that industry. But I also Kashap's being modest. When Zim was nothing, Kashap was talking about this company. So
This
like
one, yeah.
yes, Zim. So
Years ago, red hot.
Yep, I mean it was red hot when nobody was talking about it. It was moving. So and that whole industry, like Kashap was way before it ever started moving. He was talking about the fundamentals behind it, and then getting involved when it started to move. Like it's definitely an interesting sector, and I like the sectors where there's not a bunch of news flow, and that's probably part of the thing. And I only know this from the trading commodities is the less news flow you have, the more things trend. So think about cocoa. Like, there's no news flow for cocoa besides people going, "What the fuck is cocoa?" Like that's the only news flow you saw was people on Twitter going, "Why is cocoa up here?" It wasn't because people were trading it. It wasn't because it was on the news. It was just because you'd see it on your list and you go, "This thing's moving up 10% a day. I don't understand." And so it's the same thing with an industry like shipping. It's like there's not a bunch of news flow. People get hyped on the trade, once every couple of years, and you'll see it in a couple different places. That's about it. So these things can really trend and they can really move. And that's why I also like kind of being out of the biggest sectors all the time. Everybody's got to be in tech and everybody's got to do this. And even like, Kashav and I mentioned earlier, and like Steve mentioned when he got on, there's other areas to be, like their financials look great. Ian had a cool presentation where he was talking about the charts on it were awesome, which was energy. If you go across the board, basically any of the stocks, any of the sectors, oil and gas, the XOP, OIH, whatever you want to look at, there's a lot that they're all kind of waiting to break out. Now they're not there yet. They're not like something that you go, "Hey, I need to buy all these today." It's that they're all kind of at levels that they could break out at any point and start taking off. Now, I really like that, because that's something that everybody can kind of have on their screen and just go, okay, and really what's the easiest thing to do isn't to sit there and stare at it. New traders, that's what new traders do. They pull it up, they stare at it for the next month, and they go, when it moves, I'll act. And then they act early because the discipline to look at something every day and not do it is hard. So set a buy stop. Go to those levels on something like OIH, set a buy stop and kind of go, okay, now that I have a buy stop here, my position's automatically going to enter, and then never look at it again. Just don't look at it until that buy stop expires. And I promise it'll be a much, much easier way to do it. But that energy sector looks really good. A lot of these sectors look really good right now. I wanted to answer a question on here because it was, and I don't mean to get political, because I don't really want to go political at all with this question.
I had to get political this morning too, Jason, and I hated it. I hated it.
Well, yeah. I didn't even know. So I don't know much about this stuff except for my people in my house will say like, oh, this happened today. So I don't pay any attention to any of the presidential election stuff. But I do pay attention to the presidential election cycles as a trader. And so what I said was, and I just said this a couple days ago, I have an article that's buying stocks after a boring election. And the reason why I said that is because everybody I met continues to say this will be a very smooth election because both of the candidates have already been in office. Therefore, the election cycle will not happen. I think that is the most ridiculous thing I've ever heard anybody say ever. Consider I mean, I guess if you've never seen an election in the United States, then maybe you could feel that way. But like if you've ever seen it, it's never going to be smooth. So I brought up a couple different ideas, and one was the fact that as this goes on, this will absolutely be volatile. And maybe this is just the start of a little bit of volatility, but I think going forward, it'll be more volatile, probably in the summer months and as we get closer, because that's just normal. I'm not saying it because I think of what's going to happen or I can predict Trump and Biden. I'm saying it because that's just how the election cycle works every single time. September is very rocky. There will be a huge move in volatility in September and October, every single time, like clockwork. And you can play that a million different ways. I talk about how to play that in a letter recently, but another way to think about it is volatility will come off of that after the election. So right after the election, boom, volatility will change. And so volatility will end up falling off of a cliff after the election. And that's not because of whoever wins. Like some people are going to say, oh, well, if this person wins, the market's going to do great. And this person wins. All the research last year, and you guys will remember this, not last year, at the last election, all the research at the last election was if Biden gets in, you want to buy technology, solar, and so on. And if Trump gets in, you want to buy banks, energy, and so on. And then Biden gets in, banks and energy are leading the way that next year. Technology was actually an underperformer to most of the reflation trade. So what I'm saying is, whatever you're thinking, whatever people are saying online, like just try to do the research for yourself. Like make sure to use relative strength. Look at the sectors, figure out where the outperformance is. I don't care if technology is going up. People go, well, tech was going up too. Yes, it did go up. That's great. But at the same time, you want to be in the outperformers because that's how you make money. Like if you're in the benchmarks, that's a problem. Go ahead.
When it comes to certain presidents being good or bad for certain stocks, I have two fun facts for you. We've gone back and we've done the work. Starting November 2016, when Donald Trump was elected, if you look at the performance up until November of 2020, all the industry groups that we track, can you guess what the best group of stocks was during his presidency?
Technology?
Solar energy.
Yep.
Now let's do this same exercise with President Biden, who's supposed to be really, really good for solar stocks. If you start in November of 2020, up until today, what has been the single best industry group under Biden's presidency?
Energy.
Coal.
Okay. You're going into the small groups. You're tricking me.
Sorry. You wouldn't think these things is my point. Meanwhile, solar energy has been god awful his entire term.
Mhm.
Point I'm trying to make is don't play that game. It doesn't work. The other
Yes.
thing I want to say is in terms of who the market wants to be elected, they just want someone to be elected.
Yeah.
You don't want to wake up on whatever November 21st and not know who your president is. That's going to create volatility. That's going to be a problem. That, to a lot of smart people, is a high probability outcome, unfortunately, for this election, right? Which is something new. That will be the big problem. If Biden gets elected and it's a clear victory, great, market's fine. If Trump gets elected and it's a clear victory, market's fine. We wake up that next morning after election day and we don't know who our president is, that's going to be a big problem, I think.
No, I agree, and that's what all of this is to say is markets like some sort of certainty. That's it. Markets hate uncertainty. So before the election, uncertainty. We don't know who's going to be president. We don't know how it's going to go. We don't know anything. After the election, certainty. Like
Right.
most of the time. Now, once again, if this thing happens, which I'd be surprised because it's said a million times that oh no, nobody's in office and this is the end of the world, and I don't think it's probably going to happen. And so that's the lowest probability bet, but it can happen. The most probable outcome is that somebody gets elected, a president is in office, and they just go on with their own way, and all types of conspiracies come out and different feelings about it, and that's about it. Not saying those feelings are right, wrong, or conspiracies are right or wrong. I'm just saying that's what usually happens.
And another thing that I would like to just point out on this topic is that we actually have betting markets for this. So don't pay attention to the CNN poll or the Fox News poll. Please don't pay attention to any of these. Don't pay attention to the Quinnipiac polls. They're all terrible. You can go to predictit.org and people are putting real money on who they believe will be president. That's a good poll. That's money talking, right? So what happened? Trump's been in this trial thing. I don't know what's going on for a couple of weeks now. I think most of the month of May, this has been going on. He has risen dramatically in the polls during that time. So a lot of times it's not what you think. If you look at the headlines, Trump is arrested or whatever just happened, 37 counts, you would think, oh boy, that's bad. That's bad for his odds. People have been putting money on him throughout this whole trial the past couple of weeks. So it's never really what you think. To try and game something like this, I think is very difficult. Hopefully we know who our president is.
Yeah, and that's all we can really look at here. And that's kind of going to be the biggest sign that we're going to get, whether markets are going to be smooth or not. We just know who it is. That's it. And 99% of the time, it's just like, I can tell you, God, every single time I've traded an election, it's been the exact same thing every single time. Last year, or I keep saying last year like it was last year. 4 years ago, the last election, that was the best one ever for me as a trader, because I really understood the flows and I did the work at that time to really get where I needed to be that time. And the hedge fund positioning was so short at that time, it was insane. Everybody was in fear. I had a friend hit me up and told me to leave my phone at home and come here and we'll talk about what we're going to have to do after the election, because this is all going to be a different world afterwards. Literally, everybody was panicked, and all I could see was that was the who says it all the time? Jim Rogers. The Jim Rogers quote of, I wait till money's sitting in the corner and then I go pick it up. It's like
sidewalk.
Yeah, on the sidewalk, and then I go pick it up. It's like that was the one that was set up like that. Now, the things you want to look for is to see the same things. Do you see hedge fund positioning, on the offsides, meaning that everybody's short? Do you see fear in your everyday life from everybody? When you see those things, then you can kind of understand, okay, maybe I need to be ready for this move. And really, it's not just buying things at that point. Wait for moves, wait for some. Energy had that huge gap day up, and Kashat might remember this. I bought that, and everybody thought I was insane. It was because it was up 10% or something, right off the rip, and it ended up going up more, and everybody thought I was insane. But it was the best gap you could ever buy. There's a ton of volume. But once again, you didn't have to just go in and buy it, the day before or hope to catch a low. It was wait for those signals. As the signals come in, take the trades. And then those trades continued to move for what until Q1 22. So I mean, most of those trades didn't get stopped out until Q1 22. That's insane to think about. But once again, it's just the general thing that we're talking about here is understand before the election there's uncertainty. After the election, there's certainty. So that's for the TLDR people. So there you go.
Yeah, you could see that candle you're talking about. That was November 9th of 2020. Just a monster move from energy.
Monster gap. Let me see if I can find it.
I misspoke. It's not the 20th. I guess election day is like November 5th. I was thinking of inauguration.
Yeah.
Yes, last year it was on a Thursday, and then we had a Friday, and the markets really didn't start reacting until the following Monday. In 2016, markets were reacting that night.
Yes.
Futures were limit down and then limit up. That was crazy.
And that's I remember the limit down and the limit up move was wild. But I mean, once again, that's how it goes. It's how it goes almost every single time. That's how markets work. Markets are. It's not that markets are predictable. They are not. However, human action is a little bit predictable. This is why we have fear and greed indexes and understand sentiment and stuff. It's not that you can trade it perfectly. Not because people go, oh my God, these ratios and the sentiment stuff, it doesn't even matter. It's like it does totally matter, and it does absolutely work. It's just not a timing tool. And there's no such thing as a perfect timing tool anyways. So because of that, you have to be ready for these moves, take the buy signals, understand where the sentiment is. Like, okay, like the same thing I do for COT reports every time. The signal is basically based on extreme fear, extreme greed. You're at these points. However, those points can last for a long time. Think about COVID. Most people bought, if you talk to a normal person, they heard the market was down 10%. They thought, great buying opportunity.
Yep.
And they bought it when it was down 5 to 10%.
And
they got lucky because it was one of the times in history that it went down 5 to 10%, and then it went down another 20, and then it basically crashed up the other direction. Yep. You don't have that happen much. So a bunch of people got lucky, and they thought they were very smart because of it.
They're going to write a chapter in the CMT textbooks in the future about V-shaped bottoms. And it's going to be the COVID lows. It's going to be those pandemic lows from 2020, because that was just like the most epic V-shaped bottom you'll ever see.
That was a time the Fed printed $3 trillion in a single month. So it's kind of to be expected. And I don't think that's going to repeat, not with the kind of scrutiny the Fed has.
You're talking about the pandemic stimulus, right? As soon as they threw that out.
Yeah, it was $3 trillion in a single month, which was just wild.
Who knew liquidity was so important? Yeah, I totally agree. Once that news came out, the market just ripped higher, never looked back.
And if you look at last year, it was the same thing. So market was going down from Feb FOMC all the way to the bank term funding program announcement, and then it just ripped higher and never looked back.
Around the regional banking crisis, you're saying?
Yeah. When Silicon Valley Bank failed and the Fed announced the bank term funding program, that was the bottom, and the market just picked up. It's just the liquidity.
Liquidity is really everything, and it's the same, but it's also liquidity is everything, but it's also the idea of liquidity. Yeah. Right. For example, what really changed the night the Fed said it was a Sunday when they said they were going to do QE infinity. I remember it because I'm a little bit off on the day. I feel like it was a Sunday because I remember being at a bank, and this was a very weird thing that happened. I went to the bank. I went to get money out of an ATM.
You're talking about March of 2009 when people still went to banks?
March 2020.
Oh, you're talking about 2020. Got it.
Yeah, I was in Cleveland. I was riding my bike. And I went to stop at a bank for cash and just to get some cash out. And when I was at this bank, I'm sitting there and I'm trying to go to my account and like, because I couldn't get online and I couldn't transfer something online or something. I was like, well, I'll just stop at the bank. It'll be fine. I think I needed a pair of tires or something. And so I stop at the bank. I go into the ATM. It doesn't work. And then I go inside and they're like, oh, everything. Because I was like, what the hell's going on? And they were like, everything's fine. And then all of a sudden I get my money. Everything's fine. And then I see also that they do this QE infinity thing, and they had a big Fed announcement that was on a weekend. And so it was after they had already cut rates to zero.
That's right.
So once again, it's not just cutting rates to zero or the QE infinity. It's the idea of it. Because really, if you think about it, what happened? What changed on that Sunday night in the market? Did more money really get into the market already from them going to QE infinity? No, but they believed it. And so as long as the market believes it, and that's why it's important with what we do with looking at the charts, which is you can actually see the market participants. You can see that, hey, maybe the fundamentals haven't changed just yet, but people's minds have. People believe that this QE infinity has solved this market crisis, and now it's moving up. It's V-bottoming and never looking back. I mean, that was the wildest thing I had ever seen in markets till this day. That's the most unpredictable pattern. There's no system, strategy, anything you could ever build that will tell you that. The only person that I ever saw who got that pattern right and timed it is Larry Williams. Larry Williams nailed that to the day. Like, I think he might have been a day or two off something, but he literally nailed it, called it, has a video on it. If you go online, you can find it. And once again, like, even Larry will tell you, like, yeah, I have my systems, I have my strategies, I know what I am doing. But at the same time, I sometimes have to take hits. I have to try to take trades. And that's really what we all do as traders is, yeah, we're not always right, but we have to continue to take trades. And so he took it at the right time. It's a legendary trade for him.
I think this is something that modern market participants have to get used to. I am not the biggest stock market historian. I can't tell you, what helped put in the bottom, in bear markets in the past. But this has more or less been the case in this Fed-driven market that we all participate in. Even at the financial crisis, they threw a lot of relief at the market for months. And it wasn't until March of 2009, I think the second TARP, right, where they just threw like the big guns out. And this is documented well in different documentaries and books, right? There was a big argument about it. Congress didn't want to let it go. And I think the Treasury Secretary at the time, Hank Paulson and Bernanke, were like in a room and they were like, guys, this thing's going to fall apart like tomorrow if you don't pass this. And they finally passed it. The money came in, helicopter relief, and the market bottom finally. But that's kind of been the case at all of these, extreme bear market lows. You do have to pay close attention to what the Fed and the Treasury are doing because they tend to be the savior.
Yes. And that's the damn truth. And it's not that, like you said, it's not even understanding what's going on in market history, more than it's just understanding how people react to things.
Yeah.
Once in 1987, that's the first time we saw a bottom very similar to that. Very quick crash, bottomed out quickly, but it was also the first time the Fed intervened.
Yeah.
Same thing when you get in the dot-com bubble, but it takes a long time or 1998, sorry. 1998 was the next one, where you had the crash, long-term capital management. I always forget that name. Somehow I remembered it right now. But long-term capital management ends up having a big problem in 1998. They try to short the ruble or long the ruble. I can't remember. The 100% trade that they took as much leverage on as possible.
Mm-hmm.
And then a bunch of PhDs. I mean, you got to expect it. And then the market crash. They crashed the market basically. Fed also intervenes then. Then you get into 2000, we get 2001 happening. We get this triple bottom set up, and then we move forward. I mean, there's a bunch of it. So, as long as you understand those facts, you really start to understand how the market works. But timing something like that is so hard to do. It's so hard to do, but there are ways to do it. And like you said, there's possibly a thing that you have to get used to. I think the one thing that I should tell you, Steve, which is a good one to think about, so when you back test things a lot, which I'm a psychopath, and I like to drive myself crazy, so I backtest things a lot. So as a psychopath, backtesting things a lot and going, oh, that's cool. Equities work. You find out equities work one way and commodities work another way. Commodities are very trendy, but equities have always been very mean reverting.
Yeah.
And so as you see these mean reversions, you can start to build systems and strategies to catch these types of moves. However, you always wait for a bottom to form, and then you have something to go up after. So if, for example, the COVID crashes happen usually so hard that move out of it can be, you can basically just be like, okay, I'm going to buy when the stock gets over a 10-day EMA.
Yeah.
Something simple like that. And so you can just do that and kind of catch those types of moves a little bit earlier than other people would because you're using something like that. But what you don't want to do is just try to catch things as they're falling. So something simple, a very short-term momentum indicator can help. Also, I told you guys I would show you that gap. That picture came out like crap. I'm not sure why. Sorry.
No, look at that lower shadow there. Look at that.
The low shadow. I don't know why that picture looks so bad, but sorry about that. But anyways, on the left side of your screen, if you look at that bottom and then that huge gap out where that white candle is, that's where we gapped out, and that's what I bought. I bought up there, and it did come back a lot on that day. I think it came back 8% or something, but it ended up continuing to move higher. And so a lot of people, why I bring that up and why I wanted to show that, and you could talk about this a bit more, Steve, is people are so afraid of buying gaps, like new highs, gaps. Like it's like the scariest things for people to buy. However, like what you find out, especially gaps like that's out of a low. It's as good as it's going to get for an entry for somebody to get a profitable one. So, can you explain like a little bit about gaps from your experience?
Most gaps are common gaps, which means that they're filled. Now, one of the most powerful and best, I guess, candles is the breakaway gap or the gap and go. So while the odds of a gap ending up being a gap and go are low, right? Odds favor any gap getting filled. If you do catch a breakaway gap, it's just that's going to be one of the best ways to enter a new trade you'll find. What can you do to protect yourself from the chances of it turning out to be a common gap? You have clear levels. If it's a gap, you set your stop at the gap low or the even real body low if you want it tighter, right? You have levels there, so you just play that gap. If it starts to fill, that's your stop. It wasn't a breakaway gap. You don't want to be in it anymore. But at least we have tools that can allow us to take shots at these moves as they happen. We don't know if it's going to end up being a common gap, breakaway gap, even an exhaustion gap, right? The day it happens. We really don't know. We can look, we can have an idea, we can lean in a certain direction. But really, it's risk management. It's risk management, always.
The 2020 energy trade, I think Jason's really being modest here because that was a spectacular trade for him. So the background to that trade is in 2019, you had all these energy producers going bankrupt, and that's when he shorted oil. And when oil got to kind of the $40 range, everyone said, this is it. This is the level at which it's going to stabilize because
Forever.
anything below this is below the cost of production. Saudi cannot afford it. US shale can't afford it. And then it goes all the way to zero because some bank in China sold a wealth management product that was tied to the near-term futures. And whoever ran the product forgot to roll the futures contract. And then all of a sudden you had oil going to zero. So the most contracts went to zero. That particular contract went to negative $39. And you had this huge glut of oil which just couldn't be stored. So that's when we recommended the tanker trade, wherein you're buying these oil tankers because the traders were storing the oil on tankers. And the prevailing narrative all during the time, so this is from March all the way to August, the prevailing narrative was there is too much oil, there is too much oil in storage, it's going to take years for the excess inventory to get worked off, there is no demand for gas, there's no demand for oil because it's lockdown, and what are you going to do with all this oil? And then you had this huge gap up in XLE, and by then no one wanted to buy it because everyone had been on the
But that's the point, right?
Mm.
Jason, we were talking about regional banks last year, right?
Yep.
I think I said something like, I want a crisis with my bottom,
Yep.
right? We had it with the banks last year.
Mm-hmm.
You had a crisis. You had an oil and gas crisis in 2020, 2019 too. The
Yep.
whole space was washed out. The fossil fuel industry is dead and over. Biden just got elected. It's all solar. It's all alternatives. Goodbye, traditional oil and gas. That's the sentiment you want, right?
And everybody hated it. Everybody hated it. And there was more than that. It was 20. You basically owned that sector from what, 2014 all the way to 2022. Basically, you were dead. You got killed. And like we had a bunch of energy funds at that time. And if you ever want to figure out like how much I don't have a bias in trading, like I was also short that contract to zero.
Yeah.
It didn't go negative. If you were on any broker, they just told you to go fuck yourself. Here's your money. Good job. Go fuck yourself. But
what happened? So you were able to.
So once it hit zero, basically, I remember going back into my account and being like, oh boy, this is one of those trades I'm just gonna close out. This would be great, right. And it was already closed out for me.
They closed it at zero for you.
Yep.
Wow, that's
they just sent everybody's money. They just said, here you go. We're this obviously isn't real, like, and like if you argued it, nothing happened. So I wrote them like nothing happened. But once again,
this obviously can't go negative. We're not going to pay you.
Yes. So Kashop remembers because like he's mentioned, I was short it, and then it gets down to that level at 40, and everybody's like, it's impossible to go under 40. Then it gets to 20. It's impossible to go under 20. And it's not that I really like thought anything more, like I wasn't predicting, like, so I'm not trying to sit here and say I knew it. I'm just saying that the trend was down. I continued to hold the trend to the downside. And most of the time that's how you get those crazy trades is, the trend followers, when rates went negative, there wasn't a lot of people out there who were still going, we want to own bonds as they're going to go negative. People just thought that was impossible. So might as well sell out of your bond positions. The trend follower people like me, like, we just held our positions. And that's when like you had that major performance in trend following. Like we had a bunch, if you were in German bonds or whatever you were in, you continued to make all this money being on the long side of bonds, even though they went negative. It's the same thing for this trade, but also then you have that breakaway gap, and then you start to buy that, and you have all this, so basically you just got to figure it out both ways. But it's also awesome to be in an industry where everybody hates it, and then you get that crisis like you mentioned. And like you can see that in everything. Shipping, there was absolutely a huge dead period for a very long time. Now we're kind of there again. Energy, I really think that energy, even though people are like, oh, well, energy doesn't look that great. If you go back and you go 4 years and you go, okay, look at this trend. It's continued to trend nicely. It's holding up really well. It's going to continue to move higher. Like that's a really beautiful thing you want to buy. Like you want to own that breakout because that's showing you that there's relative strength there. That thing hasn't broken trend. It hasn't broken trend at all since that initial gap back in 2020.
And also from like a primary trend perspective, right? Not only is energy the sole market leader off of the pandemic lows, but the bear market in 2022 really ended up hitting more or less every sector with some nasty drawdowns. Energy was just sideways. If you zoom out on chart of energy, there was a bear market for everything else. There was a consolidation for energy.
And tankers had a great year in 2022. Right. The oil tankers, the product tankers, they all went up. In fact, the shipping guys ended up having such a great year. They were bragging about it on Twitter. Like they're up when the market is down.
That's also
and
good.
And then it fell apart. The natural gas. So, Jason, you should talk about your natural gas trade. You saw the diamond pattern breakout at around $2, and I think you rode it all the way to $12, which was insane given how volatile natural gas is. I mean, it's called the widow maker, although we kind of talk about how that's a ridiculous term because almost everything is as volatile.
Yeah, everything. So I guess the thing for me when I first started trading, everything was the widow maker trade. Everything. It could have been anything. You could put options on anything and make it a widow maker trade. I did that with everything at the beginning. Oh, cool. Well, I think this will work. Oh, I'll put them some leverage on this. Just stupid stuff when you first start trading. So I think everybody thinks that natural gas or commodities in general are like this widowmaker trade. And so even speaking of commodities, I found the chart what Steven was talking about. If you look at and I went all the way back to what I was talking about, which is back in 14, the market topped for energy, all the way downtrend. Anybody who had a fund in that sector got killed, destroyed.
Yeah.
And then you get to 2020, you got that gap, and nobody, I can promise you, there was nobody in the world who wanted to buy that gap. There was 0 people looking at that gap thinking that that was a good idea to buy it. It was stupid to buy it. Everybody thought it was stupid. It's a bad trade. It's old. Just like Steven mentioned, it's the old economy, but it's moved up and now it's just consolidated that year. So if you run just primary trend things, 200 days, 52-week lows, whatever, it hasn't hit any of those this whole time. No. So it's still in a primary uptrend. It's finally breaking out to some new highs. It's consolidating right above those. I think it's still a good trade.
And think about it this way. XLE here went 4x off of those lows. Right, so it was up like 300%. This is called digestion. That's a lot of percent. In what, year, 2 years? Probably was, not even. So this is just sideways. This is the market just digesting those gains before another leg higher, I would think. This is a continuation pattern at this point, right? It's just a continuation range where you would want to err in the direction of the underlying trend or the direction of the line coming into this consolidation, which is up and to the right. Whether it resolves today, tomorrow, this month, next quarter, next year is the question. Hey, Jason, what do I have to do to get you to change your black background on your charts?
Nothing. I don't think it could change. I'm an angsty teen.
Louis the same way, you guys. I look at your chart backgrounds, it depresses me.
Yeah, no, I mean, I like it because it's just it's mainly the being able to use just white bars on my thing, because I don't use any colors on the bars, because I think people get too like, oh, red days, oh, green, like they go back and forth on that too much. And really, if like you just have a nice clean color, and it's really hard to look at when they're black, so that's why I have it white. Just makes it easier for me.
All the early technicians, they didn't use candlesticks. They used black bars.
Yeah, I use bars. Yeah, I use bars.
The
black bars look weird to me. I don't know why. Black bars look weird. So it's like either I get the emo background or I get the black bars and they look weird to me. So I'm not sure.
No background.
Yeah. I mean, it is. It's a little. I mean, let's be honest. It's a little emo. You put this up, it looks a little emo.
Do you listen to like Dashboard Confessional while you chart?
While I chart, no. I'm more of a metal guy, so none of that. But yeah, so just to answer Kashap on the trade, to finish out the natural gas thing, natural gas has major trends. The secret to trading it well, and this is the biggest secret, everybody write this down: trade very fucking small. That's it.
Risk management too. Position sizing, isn't it?
Position sizing is the most important piece of risk management. So just trade it as small as you possibly can, and you'll do okay. When people trade things and they're like, "Oh, I've lost 20% of my account on a trade," it's like that's really bad. Like no trade should cost. I can lose 20% on a position, and it might cost me 1% of my whole overall account. That's how you should be setting up your trade. So the position should be different than your trade. So each trade should never total your total account size. Once again, the secrets are all risk management. So, all right, you guys have anything else to end on?
No, I think we're good.
Got nothing.
All right, that was great. Great job, everybody. Great job to us. I also had this chart of seasonality on copper that I thought was kind of interesting. I'm just going to throw that up for a second. Considering how bullish it was, and this goes back pretty far, considering how bullish it was already, it's kind of interesting to see seasonality kicking up. I'm not the biggest seasonal person for trading, But I'm kind of interested in seeing that this and also energy has some good seasonals coming for up. So it'd be something to watch for, not because I'm watching for it to say crude oil is going to be great or buy copper. I'm watching it to say, and this is how I use seasonals. If they start bucking that pattern, if copper gets weaker here, if oil continues to get weaker here, even though the seasonal patterns are strong, that's going to give me a hint on the environment that Kashap and I are talking about, what environment we're in. If, for example, if oil's strong, we're looking at a more inflationary environment. If oil's weak, we're looking at more of a disinflationary environment.
The signal is in when they don't do what they're supposed to do, right?
Yes, exactly. That's the best thing a seasonality can teach you, because so many people get into seasonalities and they're like, this is how it is, and I'm just going to buy this here, and then they'll be like, it doesn't work, see? And it's like, no, that's not exactly it, because nothing I put up there, those were 65 and almost 70%. Nothing I put up there is 100%. So seasonal should never work every single time. And nothing in trading does, by the way. So you got to get that out of your head too. But it's just something to look at to manage expectations, figure out what you should be looking for and what environment we could see going forward.
And to that point, if I could just give a closing thought on today's action, this is not great and getting worse. And here's why. Along the same lines of things not doing what they're supposed to do, up until today, it's kind of been a case of mega cap techs are going to trade on their own individual stuff, their earnings reports, right? We had the AI theme, we had the software theme yesterday. And then the broader market is going to more or less trade in line with the bond market. In other words, rates are up big that day. Breadth is probably poor. If rates are down, breadth is probably pretty solid. Today, rates are coming off pretty good here again today. 10-year down, what? Like one, I don't know, I have it quoted in percentages, 5 basis points. 10 years coming off, market's getting absolutely clobbered across the board. So this is a bit of a change in character just from a tape reading perspective. Don't love to see it.
No, I agree. And I think it's also, there's two things. One is sitting on your hands, like that's an important thing to do at times. But two is understanding that this is the start of a pullback. This isn't something that I would say, hey, it's total pullback. We gotta run the other direction. And also the other thing, seasonality. Getting back into seasonality, if we look at June is basically 54% of the time in the NASDAQ. It's the fourth worst month. And June is usually very volatile. June is normally a very volatile month. So I wouldn't doubt that we could see some market volatility here. Also, what's funny is one of the NASDAQ's best, and this is a weird one that just has always happened. There's a tech rally that usually happens late June into July every year. Not sure why. It's a very short-term trade, very short-term idea, but that kind of happens every single year. It's the one bright spot in the summer. So you might see a pullback here, a rally, and then what I would assume as right before the election, which is the basically the volatility that we're going to see in August, September, even in October, coming into the election. I think that's what my template for this year. Pullback here, possibly a little rally in July, and then a lot of volatility as we get closer to the election.
And I think with the Russell rebalancing coming up, it's going to be volatile with the small caps as well.
Yeah.
So you're just going to see a lot of chop. And
summer.
If I could just leave us with an old market aphorism from some great technicians that came before us, I believe the saying is, sell in May, there is golf to play.
That's just what I've heard.
Not it
similar, but I feel like you put something on that. I feel like you put something in it. Maybe the golf word.
Really?
Maybe the golf word.
I don't know. All right. I thought that was it.
Sell May and go away. I think that's what it is. Sell May and go golf. I don't know, Steven. I don't know.
I like mine more.
I think you do. I was like, yeah, it's Friday. So everybody knows, I have to run these a little bit early, because if it's like at 2 o'clock, I know Steven will be gone by that point and golfing most likely. which is good. I think everybody needs to do something. I'm always at the gym or doing something too. So I think it's important, especially as a trader. You could sit here all day and look at the market and go, I can't believe I made that trade. Why am I long this? Or you could just go do something.
A lot of days too, like if it's messy and my reports are out and I got no video or content to do in the afternoon, I'll make the decision to go golfing like a half hour before I actually go golfing, right? Like the market's messy and I'm just not feeling it that day. I want to know what you think about this. Chris Barone was on talking to us on the morning show yesterday or the day before, and he said he's like a head of research type of person at Strategas, right? 70% of my time is spent thinking, he said. When I go golfing, that's what I'm doing out there. In fact, I play with a group of guys on Saturday, and that's wild, right? And there's no thinking. But when I play during the week, I try to go out by myself, alone, get in a cart by myself. I don't even want to play with anybody at all. I'm just out there thinking. You're out there for 3-4 hours, thinking about the hundreds and thousands of charts that you look through that morning, trying to organize your thoughts in your head. Like you need something to do that pulls you away from the screens and allows you to take that step back and digest all of this just nonstop information and data that we have to digest on a daily basis. So whether it's going for a walk, going to the gym, go fucking meditate, it doesn't matter what you do, but get yourself to a place where you can just kind of organize your thoughts. That's everybody.
Good point. Well, let's leave on that. Thanks for coming on, guys. This was a lot of fun. You can see us every Friday at 11 a.m. Eastern time, and we'll see you soon. Make sure to follow Kashab and Steve Out of the Money Straza.
Have a good weekend, everybody.
All right, guys.
All right. Bye guys.